Good evening and welcome back to Fonti International. The US GDP third quarter growth is at 3.5%. The US economy slowed in the third quarter as previously reported, but the pace was strong enough to keep growth on track with the Trump administration's 3% target this year. The government also reported that after-tax corporate profits increased at a 3.3% rate last quarter after rising at a 2.1% pace in the second quarter. Gross domestic income increased at a rate of 4.0% in the third quarter, quickening from the second quarter 0.9% pace. But let me welcome our second guest for tonight, live from New York, Ergas, Chief Economist at Tigris Financial Partners. Good evening, Jean, and thank you for being with us.
Good evening.
Jean, the third quarter US GDP is at 3.5% as we saw. It's a quite satisfactory result. How do you explain the flattening of the yield curve?
Well, the flattening of the yield curve is completely different, I think, from what we're seeing on the GDP front. Okay, and what the flattening of the yield curve basically says is that this pace of growth is not sustainable. And therefore, what we're actually going to be seeing is we're going to be seeing lower interest rates, or pressure on borrowing and rates and inflation going forward. We have had a large fiscal stimulus in the economy this year. We have had a lot of front running on capital investments. We have had a strong increase in demand, and therefore this is pushing up the short-term data. That this data is not sustainable in the long run is what the yield curve is telling us.
Well, the Fed chairman, Jeremy Powell, just spoke a few minutes ago in New York. Interest rates are still low by historical standards, and they remain just below the broad range of estimates of the level that would be neutral for the economy. How do you comment that? What's your take on his words?
My take on his words is fairly straightforward. It is this. It is, look, the U.S. economy is reasonably robust. The U.S. economy is not about to collapse into a recession anytime soon. And I mean soon, I mean in the next 3 to 6 months, according to them. They will look, for example, to whether increase rates, how many times they will increase rates in 2019. But I do believe that he is indicating that they will increase rates in December. They are not at the neutral rate, they are near it. And the question is, it's extremely difficult to gauge what this point is, because one of the biggest mistakes you can make in these things is to underestimate, for example, or how much capacity is actually being used. So there is a certain amount of overshoot risk involved here. So I think it's very careful. I think they are going to raise rates in December. If they don't raise rates in December, it's a very bad signal for the economy.
But do you believe he somehow will be cracked under the pressure that Trump is putting on him?
Well, that's a very good question. The question is, why is he saying this? Does he believe it, or is it political? I think that he cannot be seen to be obedient completely to Trump, because then people lose faith in the Federal Reserve Bank. They say, you know what? This is not a serious institution. It is not independent. I will not listen to them because they are only working on the very short term and not giving me a real economic vision.
Jean, ahead of the G20 summit on Friday and Saturday, Trump threatened to extend taxes on Chinese imports. If tariffs are to be imposed on all $500 billion of important goods from China into U.S., do you expect that inflation will shoot up?
No, I do not believe that inflation will shoot up on the consumer side. It's very important to know that we are now actually moving on to the consumer products, okay? Where the inflation push really comes is on the input side, on things like steel, aluminum, for example, these types of products. So I think that, yes, there is a basic inflationary push in the U.S. economy. As tariffs, no tariffs, the economy picks up. But I do not believe that a 10% tariff on goods from China, finished product, is going to be the big push to inflation in the U.S.
Well, let's move to Europe because there is much going on also in our continent. The end of quantitative easing is approaching. From the 1st of January 2019, a new buyer of corporate debt, such as the ECB, will stop purchasing corporate bonds. What will be the impact on many private issuers, according to you? And do you envision an increase in the rate of defaults among European companies on their outstanding debt?
Well, I think it's a very good question. I think we have to distinguish between two factors. The first is the debt already issued, and the second is the debt to be issued. So the debt that is already issued, obviously, if it's fixed rate, I'm assuming it's fixed rate, will not be impacted. The problem becomes when you have to go out and refinance. And the question then becomes, how much does the absence of the ECB contribute to the increase in spreads between corporate borrowing costs and a reference rate, which could be the German Bund? And my feeling is that it should be sustainable for the top-level companies. The problem is that a lot of companies in Europe, which were junk bond rated or high yield, have seen borrowing as a form of capital and equity because it was cheap, and they could get absolutely beaten on the head. So I would not be very enthusiastic about European high yield.
Britain's government stepped up, warning today that a no-deal Brexit would hammer the economy, but acknowledged that Prime Minister Theresa May's plan, opposed by many of her own side, would also leave the economy worse off than staying in the EU. In a scenario resembling the agreement May has struck with other European leaders, nations' output would be 2.1% smaller in just over 15 years' time than if Britain remained in the bloc, the government said. But if there was no deal, it would be 7.7% smaller. So she addressed the government to vote the Brexit deal. Do you think, in case the Parliament will not reach an agreement, will not pass the draft, there would be consequences into the British economy? And if yes, which will be the sectors mostly damaged?
Good. That's an excellent question. First of all, I think the Brexit alternatives are not a choice between the good and the bad. They are a choice between the bad and the worse. Okay? So what Theresa May is proposing now is bad. The no deal is even worse. What Theresa May is proposing now is a slowing in the growth rate. The no deal is a contraction of the economy. These are two different things. I think that if there is a no deal, it will be disruptive across a broad series of asset classes in the UK, especially those who are domestically focused. It will crush the pound. It will raise import prices, it will push up inflation, and they'll have to put up interest rates, which will choke the economy. I think this is the scenario we're seeing. It will also be disruptive globally as the fifth economy in the world starts having to adjust to completely different trading practices, including administrative delays and confusion as to bank regulation and settling, let's say, of financial transactions and hedging of risks. So there's a lot of open-ended questions here. And then what I see is a risk multiplier, a negative Keynesian multiplier, where one bad thing leads to another 10.
Well, Jean, just to finish the argument with the bonds, I would like just to ask your broader view, broader opinion on General Electric's bond that were to be downgraded to junk status, what would be the impact on the junk bond markets? To give an idea of the impact of a potential downgrade, General Electric has bonds rated BBB for 50 billions. The sum would be 3.9% of the roughly $1.2 trillion junk bond market. What's your view?
Yeah. My view is, first of all, GE, from what my colleagues who are experts in this, in the U.S. market bond, tell me, is already trading like junk. Now, I do not buy the argument that because it's trading like junk, it is junk. In the sense that it's already considered fully junk. This is the point. You can trade like junk, but still be investment grade formally. And what this means is that companies can theoretically still buy your debt, and that other investors do not have to sell it. If you go to junk formally, there may not actually be a big distinction in the rate of the yield, but what will actually happen is that your financial flexibility will collapse because many investors are not allowed to buy your debt. And then immediately afterwards, assuming that most of the selling has not taken place, because this we do not know how much was sold or not before the potential downgrading, you can have an avalanche of your debt hitting the market, and that can be extremely negative. What would it do to the junk bond market in and of itself? I think it would be a weight on the junk bond market. And I think the junk bond market could already be under pressure in the United States because spreads will go up, and if oil does not pick up, we may start seeing problems from another side, which is the energy bonds, which are issued in the high-yield market. So it would be one more factor complicating the U.S. high-yield sector.
Jean, thank you for your view on that topic, but talking about oil, I would like to ask you, I mean, right now WTI is at $51 a barrel. Do you think prices may go down further? I mean, they're already so down. Like, is it possible to go further?
Yes, I think it is. I think people thought it was impossible that they would go below 70. Then they said it was impossible to go below 60. And now we're flirting with 50. The question is not so much, to my mind, can they go lower? The question is, how long do they stay low? I think we could certainly see overshoots, or we could certainly see a further descent, depending on the rumors in the run-up to the December the 6th meetings. We could see rumors coming out of the G20 conference. And I think that these are markets that are rumors rather than facts. So I think we could go lower. I think we could go lower. I do not exclude going below 50. I see the potential for the upside as relatively limited because I don't think that Saudi Arabia wants to get Mr. Trump very angry at this point.
So you don't believe that the OPEC meeting on 6th of December, the OPEC countries, exporters, will decide to cut outputs only because of Trump's tweeting?
No, I think it's just make a distinction here between cutting output and the impact of the cut in output. If I believe that the market is oversupplied, and I believe that the U.S. government controls Iran's cash flow via the waivers, and I believe that the U.S. shale industry is going its own independent course and stepping up production much more than expected, I think that OPEC has a limited flexibility to act. And I believe that even a cut by OPEC, A, they will be cheating, and B, it will run up against opposition from Russia, for whom these prices are acceptable, and will not feel bound by this agreement.
I see. Thank you. Thank you, Jean Ergas, Chief Economist at Tigris Financial Partners. Thank you for being with us live from New York.
Welcome. It was a pleasure. Thank you.
Thank you. Good evening. Well.